thank you for having me. I'm delighted. This is my first time at Binance Blockchain Week. Impressive, very excited. You know, I see a lot of yellow. I guess today's an orange and yellow day. Thank you for hosting the orange. I'd like to share what I see as probably the most exciting development of the past year, which is the worldwide embrace of digital capital, digital currency, digital finance, and digital credit. And Binance is a big part of it. Everybody in this room is a big part of it. And I'm going to share my perspective on it. And I thought I'd start just by observing. By the way, there's supposed to be a timer here. The timer's wrong. Could you? It says I have 12 hours and 40 minutes. Yeah, you guys are in trouble. I could actually fill the 12 hours and 40 minutes. Let's start with an observation. There's a revolution in the capital markets going on. And that revolution is impacting the capital markets for currency globally. It's impacting the capital markets for equity. It's impacting the capital markets for credit. It's impacting the derivatives capital markets. And the basis of a lot of this starts with Bitcoin. And it starts with the embrace of Bitcoin by the global financial community. So Bitcoin is emerging as digital capital. And why is it digital capital? Because the President of the United States, Donald Trump, has styled himself the Bitcoin president. He's declared he wants to make the United States the crypto capital of the world. He's decided he wants to lead in digital innovation, whether it's digital assets, digital capital, digital finance, or digital intelligence. And you can see that it's not just rhetoric, because he's appointed a cabinet, and that cabinet consists of an incredible array of digital advocates. The Vice President of the United States is an advocate. The Secretary of the Treasury, Scott Bessent, is an advocate. The head of the SEC, Paul Atkins, is an advocate. And not just the financial regulators, you also have non-financial regulators like Tulsi Gabbard, Kelly Loeffler, Robert F. Kennedy, even the head of the FBI or the head of Commerce. You've got an unprecedented support for this asset class across those people running the entire government of the United States. And this is a big deal. We've come a long way in 12 months. The second thing that's happening is that for Bitcoin to emerge as digital capital, you need the banking industry of the world and the banking establishment to embrace it. And they were fairly hostile to the entire crypto industry until about a year ago. And even a year ago, with the change in administration, there was uncertainty as to whether or not the banking regulators would actually make good on the campaign promises of the Trump campaign. And what we've seen is they have. There's been a series of announcements by Treasury, by the OCC, by the FDIC, by the Federal Reserve, and even joint bulletins from all those financial regulators. The sum total of them to say crypto is good, Bitcoin is good, it's okay to bank it, it's okay to lend against it, it's okay to custody it. We know that the previous administration punished banks that engaged in crypto activities. We're not like them. There's a 180-degree sea change. So banks are the most bureaucratic, risk-averse institutions in the world for good reason. You would think that from the point that the tone at the top changed 180 degrees, it might take a bit of time. I mean, for all the banks in the world to embrace crypto, to embrace Bitcoin, in 4 to 8 years would be fast. What you see here is it's happening much faster. What we've seen is BNY Mellon, PNC Bank, Citibank, JP Morgan, Wells Fargo, Bank of America, Vanguard, all of these have flipped from a hostile, negative, or skeptical view to a positive view in the last 12 months, right? We have announcements. Schwab is going to custody Bitcoin and extend credit against crypto assets early next year. Citi is doing the same thing. It used to be, I couldn't get a loan against Bitcoin from any major bank, and now if I counted the top 10 banks in the United States, 8 of them are actually engaged in crypto lending, and they've all flipped their stance in the last 6 months. So this is a major change. Wall Street's embraced Bitcoin as collateral, as capital. We were the first company that was publicly traded with a substantial holding of any crypto asset, and the first company with Bitcoin on the balance sheet. Then there were a dozen, and then there were 2 dozen, and then there were 60, and now there's a lot more than that. When we started doing it, there were no ETFs. And you can see that the first ETF was approved January of 2024. There's 85 worldwide. And of course, the most successful ETF in the history of the world is BlackRock's IBIT ETF. So you can see that Bitcoin has exploded through all of the fund business. It has exploded and been embraced through hundreds of publicly traded companies. I mean, to think we've gone from just a handful to more than 200 in 12 months is just an extraordinary move. Bitcoin is the economic foundation, the ethical foundation, and the technical foundation of this entire market. If you consider why, it's because it has the most power. It has the most electrical power, 24 gigawatts. That's 24 full-on nuclear reactors. That's more energy than drives the US Navy. It has more computer power, more than 1,000 exahash. That's more power than all the data centers that Microsoft and Google could muster together. It's got more trading power. There are 1,000 exchanges. Anybody can trade this anywhere in the world. Anybody can custody this anywhere in the world. Anybody can transfer this asset anywhere in the world. It's got more political power, right? We've got hundreds of millions of crypto enthusiasts. We've got hundreds of millions of Bitcoin holders. 30% of the registered voters in the United States are pro-crypto. It's got more economic power. More than $1 trillion has been invested in this network. $1 trillion of real capital. My company has spent something like $48 billion to acquire 3.1%. And so if you basically take 3.1% to a 48 billion and you scale that out, you see how much real money is flowing into this network. So the first big idea is you now have digital capital, a store of value. But that's just the beginning. That is the basis of an entire digital finance and digital credit industry. And all of these companies capitalizing on this can do lots of different things. You can rethink insurance, you can rethink banking, you can rethink trading, you can rethink all sorts of finance. We have focused upon rethinking credit, and so we are the first digital treasury company. What do? We created a capital balance, about 650,000 Bitcoin as of now, and we've acquired that consistently over the past 5 years. We're acquiring a huge amount of capital because we want to use it to create an extraordinary new kind of credit. Right now, we're the 5th largest treasury in the S&P 500. We're climbing our way. I think we'll be number 2 in the next couple of years. And in 4 to 8 years, we expect to be number 1. And we're doing that because we are positively polarized to capital. If you look at this chart tells a story, which is every company on earth, if it's conventional, is capitalized on money markets. The money markets return about 3% a year. That's the conventional finance strategy. But if you were to capitalize on Bitcoin, you'd be returning 47% a year. It doesn't take a rocket scientist to see that if the cost of capital or the hurdle rate is 14%, that's the S&P index, then any company capitalized on money markets is destroying shareholder value as they accumulate capital. But any company capitalized on Bitcoin is increasing or creating shareholder value. So when I say we're positively polarized, what I mean is every company that capitalizes on digital capital can raise more money and get more powerful forever. And they're competing against companies that are capitalized on fiat currency or conventional money markets that are getting weaker the more capital they carry on their balance sheet. So conventional wisdom is decapitalizing companies. Digital wisdom is recapitalizing companies. The secret to our success is we simply raise capital at the cost of credit, 6 to 12%, or the cost of equity, 14%. And then we buy something appreciating 47%, and that's how you get to a 65% return. We raised $22 billion of capital last year. We've raised $22 billion of capital this year. And so all of that money is flowing into the crypto economy. And we have raised capital a variety of different ways. You can see it was $16 billion of equity last year and $13 billion of equity so far this year. But we're also drawing in capital via digital credit, about $7 billion of digital credit, these public instruments like Strife, Stride, Stretch, etc. And then also traditional debt. The company's mission is to increase Bitcoin per share. So people that are hyper Bitcoin maximalists that want more Bitcoin would buy our equity because every year we're increasing the Bitcoin per share. If you want to just buy the underlying asset, you buy the ETF because that's equal Bitcoin per share. This is a snapshot of our capital structure. Right now, about $60 billion of BTC reserves against about $8 billion in debt. So it's a fairly low leverage ratio. We have about 73 years worth of dividends. The company pays out $800 million of dividends a year. For us to pay that money forever and grow shareholder value, Bitcoin would have to appreciate 1.36% a year. That's the cruise speed. So when you think about what our bet is that Bitcoin will appreciate more than 1.36% a year. If it does, we win. It's just that, by the way, the equity wins. If it doesn't, then the equity isn't a good investment. What we did this week was we raised a $1.44 billion US dollar reserve, and that gives us 21 months of dividends. We did that so that we could pay the dividends without selling equity or BTC derivatives or BTC if none of those capital markets were open to us. You could think of it as we can hold our breath for 21 months. Like if the market is irrational or closed for 21 months, we can just pay out of this reserve. It's like a battery. And so the company's strategy is when our equity is trading above the net asset value of the Bitcoin, we just sell the equity. It creates shareholder value. And when the equity is trading below the value of the Bitcoin, we would either sell Bitcoin derivatives or we would just sell the Bitcoin. You could think of it as, here you have a spaceship. What is our goal? Our goal, by the way, is to create the best digital credit. Our goal is to provide you with a bank account that pays you 10% instead of your bank that pays you 4 or 3 or 2 or 0. That's what STRC is. So that's our goal. The way we do it is we have a Bitcoin reactor, a crypto reactor in the middle of the company. It's charging a battery. The battery is a US dollar battery. The battery is for short term. The reactor should, presumably, if Bitcoin appreciates 1.3% a year, the battery runs forever. Or the crypto reactor runs forever, right? If Bitcoin appreciates 0, then the reactor runs for 73 years. And then we just fuel the entire machine either in the equity capital markets or the BTC market or the BTC derivatives market. I'm going to skip this in the interest of time. Important point I'll make here is we have a credit model. It's on our website. We update it every 15 seconds. You can pretty much plug in any assumption you want about Bitcoin and volatility and ARR, and you'll get out the risk. We just got rated by the S&P. Our goal is to be the first investment grade Bitcoin holder and the first investment grade crypto company where we can issue investment grade debt. We have to start at the bottom and crawl our way up. So we start with a B rating or a B minus rating from the S&P. We got this before we raised the $1.4 billion of reserves. Hopefully we'll get upgraded over time. But what that did do is it allows us to sell credit to an entire class of credit investors that have to have a rating. So it tripled the capital market for our credit when we got that rating. So that was a good thing. What is the company doing? We're transforming capital to credit. You have a 5-year-old kid. You can give them an acre of land in New York City, that's capital, and you can say in 10 to 30 years, you can either sell this land or you can refinance this land, and in the meantime, there's no cash flow. That's a capital investor. On the other hand, you can also give the kid an annuity. This is an annuity and it pays you $10,000 a month forever. That's credit. If you want to give the kid $10,000 a month forever, you give them a credit instrument. If you want to give them the ability to get rich in 30 years, you give them the capital. Bitcoin is capital. It's volatile. It's high performance. There's a lot of people that don't want it. The world is built on capital, but the world runs on credit. And so in order to convert capital into credit, you take BTC currency and you make it USD or you make it euros, or we could create JPY. You strip the risk by over-collateralizing it. You damp the volatility by giving it a par value, a liquidation preference, and by managing, say, the dividend rate. You extract or distill the yield. You can set the yield, say at 10% or whatever percent you want, and adjust it. And then you compress the duration. The capital investor, if you own Bitcoin, I say you got to hold it for 10 years, you'll get rich. But you get no money between now and then. The credit investor is, I'm going to give you immediate gratification. I'm going to start giving you cash dividends next month, every month. Okay, there's a place for both. In fact, the average person has certain money they need to have in credit and other money they need to have in capital. What we're doing is transforming digital capital to digital credit. And we've done it and created these various digital credit offerings. Strike is structured Bitcoin. It pays you a yield and gives you upside while you wait if you want the best of both worlds. Stride is super high yield, long duration credit. It's actually paying 12.9% effective yield right now. If what you want is max cash flow, then you would want something like this. Strife is super senior credit, so it's senior in the capital structure, has the most governance rights and liquidation preferences. It pays less. If you want investor protections, you get 9%. If you're willing to waive them, you get 12.9%. There are two different sets of investors. The investors that buy the one won't buy the other. We created both of them intentionally. Stretch is the most advanced instrument. What we did with Stretch is we wanted to create a high yield bank account where it would hold principal around $100, very, very close to that, and then would pay out a dividend every month. In order to do that, we had to make it adjustable every month. And so this is the first example of a Treasury credit instrument issued in the industry. In fact, it's the first instrument of its time ever issued in the history of the capital markets. Nobody ever created a variable rate preferred equity until we did it. The reason we were able to do it is we had digital capital. You can't do it without digital capital. We had digital intelligence. I designed this with AI. It never would have come to market if I didn't have AI, because the lawyers told us they'd never done it before. The bankers said, we've never done it before. Everybody else said, it's never been done, it can't be done, it won't be done. And I said, well, the lawyers and the bankers say it can't be done. Can it be done? The AI said, yeah, of course it can be done. It's very straightforward. Do this and this and this. And so I basically fought and then convinced. You can convince people, you just need to have a lot of intelligence on your side. So we use modern technology to develop this, and I'll show you how it turns out. The fifth thing we did was stream. We created a Euro version of Strife. So if you're a Euro investor, you don't want European currency risk. You want to be paid in euros and you want Euro par value. So we launched that about a month ago. This is stretched for the past 5 months, or since August 1st. You can see it came out just around 90. It's up around 97 right now. We've adjusted the dividend. Now I want to show you, I'm going to show you the difference between capital and credit here. That is stretch versus Bitcoin. If you had $100 and you bought $100 of Bitcoin on August 1st, you would have lost $27 in the past 5 months, and you get no dividends. If you had bought Stretch, you would have made $7, and you would have collected $3.70 of dividends. So you look at that and you say, well, the Stretch investors did very well. In a bear market, the credit investors outperform the capital investors. Well, why does anybody want to buy Bitcoin? Well, because Bitcoin's up 50% a year for the past 5 years, and you're only going to get 10.75% on Stretch in steady state. But you're going to have to stomach the drawdowns, the roller coaster, if you want the capital. Again, ergo, if you have a 4 to 10 year time horizon, you should take the capital. But if you need the money in 4 months, 4 weeks, 4 days, or less than 4 years, or if you're risk adverse, you should take the credit. And you can see it takes a company like ours. You need a treasury company to strip the volatility and the risk off of the capital to get to the credit. That's what we're doing. And we're doing it increasingly aggressively now. This entire digital credit category we created in January. You can see it's gone from nothing to nearly $8 billion in 9 months. You can see liquidity is off the charts. This is the trading in those digital credit instruments. And this is per day, so sometimes you're getting to 400 or 500 million in a day, or 400 million. Let me put this in perspective. The average preferred stock is listed over the counter, trades 100,000 a day. The typical public preferred stock that's successful, that is taken public, trades $1 million a day. The first securities we created, our first digital securities like Strife and Strike and Stride, they were 30 times more successful than that out of the box. They're trading 30 million a day. And then we finally got it right with Stretch, and we created the instrument everybody wants. It's trading 140 million a day. 100x, right? How do you know something's working? It's 100 times better. And then we stumbled on something. Necessity is the mother of invention. We stumbled upon this observation that if you actually fund the dividends by raising capital, either through equity or through the derivatives market or the BTC market, then the dividends you pay are return of capital, which means they're tax deferred, which means you don't have to pay the tax on them. And this is profound, right? We created a way to pay you dividends where the dividend tax rate is 0, not 20, not 30, not 50%. And of course, the company then sells the credit to buy the Bitcoin to create this amplification. So if you're wondering, Why does the equity have value? The equity has value because we're able to create the credit. And the more credit we sell, the more BTC yield we generate, the higher the equity value will be. And so let me just break this down with a few quick observations. First, there's a revolution in credit markets. This is $300 trillion market. Why is digital credit better? Because you're building it on an appreciating asset, Bitcoin, not a depreciating asset, not a rusting warehouse or a product or a service. It's better because it's transparent, homogeneous, and continuous. We update the credit model every 15 seconds. It's not like 10,000 mortgages wrapped into a mortgage-backed security. It's not like corporate credit or sovereign credit. It's better because it's equity, not debt. Bank credit is debt. Bank deposits are debt. Corporate credit is debt. What that means is they amplify risk to the issuer. Equity mitigates the risk. It's technically impossible to go bankrupt if you're actually creating amplification with equity, because the equity never comes due and the dividends can only be paid out if they wouldn't make you go bankrupt. The perpetual nature is another big change. We'll pay you the dividend forever. How do we pay the dividend forever? We invest the money forever. We're investing the money in the crypto economy forever. We're paying the dividend forever. Every other form of corporate credit is short duration. And then we tacked on this idea of taking it public. And because we took it public, it's liquid, it's global, it's easy, it's branded. There's a word, stretch, STRC. Anybody can buy it anywhere in the world. And we create the credit digitally. If you give me 500 million, I create 500 million of backing collateral, and I do it simultaneously before the day is over. Imagine you wanted me to create $500 million worth of buildings in a single day. You see, we're running the investment cycle in one day, and it would take a real estate company 5 years. And it would take a company years. So the speed at which you're doing this is unprecedented. And then if you do it in a treasury company with that model, it all becomes tax deferred. And so what you see here is, on the left, traditional credit can pay you 2, 3, 4%. We can pay 10 or 12. We can pay higher dividends because we have a more efficient product and we have innovations in that credit. And that's based upon our business model. What is a Bitcoin treasury company? We sell securities to acquire capital. We issue digital credit, and that's tax deferred, and then we pay the dividends tax deferred, and the capital appreciates tax deferred. It's triple tax deferred. This is the most efficient, scalable fixed income generator in the world. Like there's no other type of company in the world that can generate billions or tens or hundreds of billions of dollars of dividends tax deferred. You can't do it with oil and gas. You can't do it with real estate. You can't do it in the traditional way, selling products and services. So the breakthrough is based on digital capital and this new type of business model. You think of the company as a digital credit factory, really. We're swapping US dollar yield forever to one set of investors, and we're creating BTC yield for the equity investors. And you can do it with dollars, you can do it with euros, you can do it with yen. Ultimately, what's the result? Well, return of capital dividends give you 64% more money. They just pay you a lot more. And when you compare them to other opportunities, if you're a United States citizen, your bank's giving you 40 basis points, the money markets are giving you 400 basis points, taxable. We're giving you 10.8% and stretch. That's a tax equivalent yield of 17%. So that's 4x the money market. That's 20x what the bank wants to give you. If you live in New York City, it's a bank account that pays you 22%. Or you can collect 4% from the money market. Like, it's so much better, right? That you can't really imagine why would you want the other thing. This is Europe, right? In Europe, the money markets pay you 1.5%. Stream pays you 12.5% effective yield, but if you're getting taxed, it's almost 20%. You live in Vienna or Brussels, there's like a bank that pays you 27% interest. Think about it. Right? This is the revolution. We're basically going to digitally transform the banking industry, the money market industry, the credit industry. And it's not just stretch. Every digital credit instrument is so much better than every conventional credit instrument. It's not even funny. Like, look at junk bonds. They pay you 6%, and our instruments are tax equivalent 14 to 20. Or look at private credit, it's 7. It's opaque, it's heterogeneous. And of course, look at the entire world. Stretch is a 17% tax equivalent yield. The money markets in the US are 4%. In Korea, they're 2. In Europe, they're less than 1. In Singapore, 1. In Japan, 50 basis points. In Switzerland, they're negative. So when we talk about digitally transforming the world, what we're really talking about is fixing the money and fixing the banking system and fixing the credit system. And remember I said the world runs on credit? Okay, well, how are you supposed to give your kid an annuity in Switzerland or Japan when the bank's offering you nothing? Right? How do you get 10% in Swiss francs or 10% in yen? And the answer is digital credit. And all of these companies that are transforming the world, they're going to go into Japan like Metaplanet or Switzerland, and they're going to go into Korea, and if it's not our company, it'll be another local company. And the truth is, the world, the world wants a 10% bank account. So I'm going to make one point, right, which is if you walk down the street and you ask 100 people, what do you want? Do you want to get 30 or 40% a year with 40 volatility? Between 1 and 5 say, yeah, I could put some of my money into that. But a lot of people are afraid. If you ask the average person, would you like a bank account that pays you 10% tax deferred? Everybody wants that. So if you're not sure what you want, you probably want something like Stretch, STRC. And if you think about the implications of this for the digital economy, what this means is that on a foundation of Bitcoin, digital capital, we're going to see digital credit spread into every single market, and it's going to fix the banking system. It's going to fix the money market system. And it's probably going to reset the cost of capital for corporate credit, private credit, other types of credit securities. The winner is the investor. The winner is the digital economy. The winner is the Bitcoin holder in the Bitcoin community. The loser is any bureaucratic, antiquated oligopoly that wants to keep your money and pay you nothing. And that's a lot of different systems everywhere in the world, but we're reforming that system to the benefit of humanity. And you're all on the journey with us, so thank you for your support.
Fantastic. Michael, thank you so much for your presentation and for sharing your insights. If we have time, I would love to just pick your brains. We have one question from the community, and I think you've explained so much on the longevity of Bitcoin and the reasonings why. We have Binance's flagship event. We have people watching from all over the world. If you had one final message to give everyone, markets are cyclical and we've seen the ups and downs of the movements, but why Bitcoin? Why now? Why always?
Yeah, my message is digital is changing the world. It's very obvious. Digital intelligence is going to go into your car, into your robots, into your phones. We're going to have 1 billion AIs. The cars will drive themselves. Robots going to make stuff. If you want to make stuff, do things, think about things, you got to think digitally. Digital assets are going to change the world. Digital currency, digital equity, digital credit, digital finance, digital securities. It's all digitally transforming. A very simple lesson of digital is there's nothing you can't do better digitally. If you think about the advances in digital photos and digital video and digital education and digital entertainment, the digital transformation is upon us. Right now, we're transforming capital markets, transforming banking, My message to everybody is figure out how to harness the power of digital technology to provide your good, your service, your product, your investors something better. Serve the citizens, serve your customers, serve your family, right? There's volatility in the market, there's sound and there's fury, there's skepticism. You know, there was skepticism about electricity, there's skepticism about automobiles, about airplanes. Every technology's got skepticism. People weren't even sure they liked nuclear power for the past 50 years, right? We stopped nuclear energy from 73 to 2023, and then all of a sudden they decided that infinite clean energy was probably not a bad idea again. So there's always going to be skepticism of the new, but I wouldn't get caught up. I wouldn't be afraid, or I wouldn't be cowed by the volatility. The volatility means this is the most powerful, vibrant, useful thing in the entire capital market. That's why it's volatile. And there's energy there. You can harness the energy if you're not afraid of it. Don't run away from the fire, run toward the fire. That's what I would say to everybody. If you can't handle if you can't stomach 50 vol or the volatility of the capital, then there's a simple answer, the credit. Either create the credit if you're a builder, or buy the credit if you're an investor. You can have the benefits of the crypto economy without the volatility if you buy digital credit. And if you don't want that, then you can create the credit. And if you want raw power, plug digital capital into your country, your company, your family, your product. I think it's the most extraordinary thing of our lifetime.
Michael, thank you so much for joining us. Round of applause for Michael Saylor, everybody.